This is a great segue into a video that I can do on the types of due diligence that I conduct when considering investing in a property development fund or property development syndicate. As always, the boring but important stuff. This is not any form of financial advice. You need to speak to your own advisor and do your own research. By going past this point in the video, you agree to be bound by the disclaimer, which is linked in the description section of this video below. From this point, what I then do is recreate my own quick and dirty feasibility from their financials. And the reason why I do this is so that firstly, I can see where my assumptions are different to theirs based on my quick and dirty feasibility. And also I can look at my own metrics for returns and see how it benchmarks. Let's get into migrating all the financials across into my own quick and dirty feasibility, and I'm going to do that through clicking my fingers. Ready? 1, 2, 3. Great, we have it all in front of me, and now I just want to talk about a few different things. Firstly, my GRV calculation was the $699 average sale price times by 23 townhouses, effectively 16.1 million. But when you check it against their project management fee, you basically just divide the 655 by 0.04, their GRV is effectively 16.4 million. So there's a difference there, and there's a question which I would ask. The next thing is net sale. I don't know where they've got their 13.9 million on their net sale. My deductions were effectively the GRV, less the GST, less the agent's fee of 2%, less the conveyancing, and then add that back in, and it gives us effectively $14.645 million. As we move along to costs, what I have here is the land. Now you'll notice with the land, effectively it's 3.5 million plus 10% GST, so it's 3.85 million, and I try and include all my costs inclusive of GST. Again, I don't have their financials, so I'm unsure as to what is inclusive and what is exclusive. But remembering, I put notes here to make sure I remind myself which page of the IM I got the information from, and then I cross-check it. Stamp duties from the Office of State Revenue website. Conveyancing is not going to change things here nor there. Consultants' fees of about 2 to 3% of the construction cost sounds fair and reasonable to me. The site works of $650,000 sounds okay. My calculations would be around about 17-ish thousand, but there's also council contributions and other things which I might not be aware of. Moving on to construction, this is where I think it's a little bit aggressive, and again, I have made some assumptions. My first assumption is the 140 square meters. Now, the way I've worked out 140 square meters for the townhouses is by going into the IM contents. And in the IM contents, they have an average selling price of $5,000 a square meter and the average sale price of $699. Also in the IM, they do have a lot plan which shows sizes of about 120 to 130 square meters. Then on the IM, we use a construction figure of 5.75 or 5.8 million, which I've got, and you divide that by the 140 square meters, and this gives you about 1,800 bucks a square meter. Look, I think $1,800 a square meter, you will get some economies of scale building 23 or 24 townhouses, but to get to the spec of Wembley might be a little bit aggressive. Rates and taxes are in line with my calculations and the IM calculation. The other expenses are made up of $980,000 going to the syndicator and $500,000 of funding costs. I've then gone into checking the funding costs. This is what brought up a little bit of an inconsistency in the IM, which is worthwhile asking a question further. First things first is in the IM, they do state that they'll be getting a borrowing facility of $8.75 million to construct. Then later in the IM, a couple of paragraphs down, they say they'll have a $1.25 million facility plus an $8.15 million facility. So are we borrowing $8.75 million to construct, or are we borrowing $8.15 million to construct? I don't know, but again, that's a question which you should ask. So how do you check the funding costs? Well, again, it is all about benchmarking and ballparking. The formula to work this out is the total amount of debt, $875,000, times by a drawdown. So for townhouses, it's about 55%. So remembering, we're not paying or borrowing all the money at once, we're drawing down as there's installments of the building contract, times that by, said 18 months, 1.5 years, and then I times that by a rate, so 4, 5 or 6 or 7%, and at 7% I hit that $500,000. So roughly I think that $500,000 borrowed at 7% drawn down through construction is commercial and around about the correct rate. Marketing is about 1% of gross realised value, which is kind of ballpark right. Contingency worked out to being about 4% of construction. Normally I like to see that closer to 5%, but again, that's not a deal breaker for me. The next thing I check is the funding assumptions of the IM, and banks generally lend on two key parameters. The first is loan to total cost, and the second is loan to gross realised value. or net sales value. Loan to total cost is the hard costs that the development will incur. This is things such as the land, it is the consultants, the site works, and the construction. So effectively on this particular project, there's about $10.5 million of hard costs. The ratio that you then use is effectively the debt, which is 8.75 million, divided by the 10.5 million, and this gives you a loan to total cost of about 84%. The next one is their loan to net sales. So effectively using their assumption of $13.9 million is their net sales, and you divide 8.75 million of debt by the 13.9, and that gives you around 62%. While we are on the topic of funding, the next thing worth talking about is pre-sales, and in the IM they do state that they will need pre-sales to commence construction. A good benchmark for the amount of pre-sales you need is 100% of debt cover. The way the bank looks at debt cover is effectively the net sale revenue that you achieve on your project divided by the total amount of units, so 23, so 13.9 million divided by 23 units effectively means that the net sales revenue per unit is about $600,000. Then you get the total debt, which is 8.75 million. You divide that by $600,000, and effectively it tells me that this project will need about 14 to 15 pre-sales in order to hit 100% of debt cover. It is worthwhile noting that the metrics I'm using for loan to total cost and pre-sales is related to primary lenders or the main banks. Now, if the developer was to go to secondary banks or private funders, these metrics may not apply, but ultimately I benchmark my due diligence into an IM based on would a primary lender lend to this project, and if they probably wouldn't, should I be putting my money into this project? Moving on to the project's profitability, it nets about 16.5 to 7.5% margin on development costs, which is the project's profit divided by the project's total costs. And herein lies the problem with syndicators, and I'm not saying these guys are doing it, but in general with syndication, if the project was a lot more profitable and it made margin on development costs in excess of 20%, the syndicator is inclined to increase their fees because the investor accepts a return around that 15 to 20% mark. Moving along from the financials to the timeline and delivery, I do think that they are being a little bit aggressive in their assumptions. For example, they're suggesting that they'll get the development approval and market in the same month. My experience is you get your development approval, then you get your off-the-plan contracts, and you get your marketing renders, because up until you've got your planning approval, a lot of things can change, which means that the actual pre-sales might start a month to two after your planning approval. The second thing is considering the total amount of pre-sales which you will need. For example, in this they're suggesting they only need 2 months of a sales campaign in order to achieve pre-sales to be able to start construction. At 14 or 15 sales, this means that they need to be making 7 sales a month over 2 months, or effectively 2 sales every week. This is pretty aggressive based on looking at the Wembley market and the market share which you're making, and also just the sales volume of off-the-plan contracts in Western Australia at the moment. The next thing to do is head out on site and have a look at the location and the area. Put your hat on as if you're a buyer and just see if there is anything that will turn you off buying a property in the development. Effectively, I'm on site and straight away I noticed it is on a busy road. A main road does seriously impact some of the pre-sales. Also behind me you'll see that there are some high tension distribution power lines. These are probably not high tension enough to impact valuations, but it is to be importantly mindful of. Also, buyers are fickle, and in off-the-plan sales, the buyer is using the immediate location, the road, the power lines and the property that are nearby to determine if the area is somewhere they want to live. If they are inside the property, they're often looking at the fixtures and fittings, but remembering we're selling off the plan. So looking at the properties next door, making a determination as to whether they present well is something you should be doing if you are considering investing in the syndicate. I've sent the drone up, and by drone I mean my camera tripod, but it's worthwhile looking at what the adjoining properties are. Nearby there's a commercial property here, and there's also some apartments which overlook the development site. The topography of the site is fairly flat, and also there's some large trees on the site, so it's worth noting with the syndicator, are these trees going to remain on site or are they going to be cut down? So let's crack on and go check out one of the comparable properties. What I normally like to do is look at properties which are on market, properties that are sold, and properties that have been withdrawn. But for the sake of this video, I'm just going to go to the most comparable property, which is a 3-bedroom, 2-bathroom townhouse, which was built a couple of years ago in a complex. Okay, we are out on site at the property, which I think is the most comparable in terms of the sale. I've had a walk around the complex. It is quite large, and I have to admit up front, looking back on my computer and RP data, I was wrong. It's a 2x2 townhouse, slightly smaller than the proposed ones in the development, and it sold for $662,000. The complex is a couple of years old. Now, I'd say the location of this complex is superior, and the finish based on the construction budget of the development is superior. There are some things that make it inferior. Firstly, there's a lot of adjoining walls where the proposed lot plan of the Syndicate doesn't have as many adjoining walls. So from all of that, I would think that it's likely that you could achieve $700,000 sales prices for 3x2s. The only issue is the location, and I feel that getting pre-sales in that market could be quite hard. While I've got you here, what I also wanted to talk about is how long this property took to sell. It took 192 days, which is quite long for the Wembley market. Now, given it might be because 2x2s is not in demand as much as 3x2s in the area, but it's important to note that if you are looking at a 2-month window to achieve 15 pre-sales, based on that time on market, that might not be possible. Now, it's not to put the IM down, but what it is to talk to you about is going out and looking at third-party information like other property sales, other projects, to determine if the promises made in the IM is likely to be achieved. As we head back to the office, some further things which I'd ask from the syndicator. First things first is a copy of the trust deed, because often if there's any inconsistencies between the trust deed and the IM, the trust deed would supersede. I'd also want to get any material contracts that the trustee or the company has gone into. So for example, the project management agreement or sales and listing agreements. The other item which I would consider to be important is to have an understanding as to how much the syndicator is personally investing into the deal in terms of cash or hurt money if the project doesn't proceed. And finally, I would want an understanding of what their track record is on delivery, specific projects, specific examples, and what they were doing on that particular project. After a whole day of looking into this site, hopefully you guys will know now to look at the fees in a little bit more detail, a little bit about the formation and structuring of the property fund or syndicate, an understanding of the financials and the debt side of things, as well as going out on site, looking at the property and looking at comparable sales with a few extra hard questions to ask the syndicator. So until next time that you find a great syndicate or my next video, best of luck and goodbye.